Welcome back to What's Hot and What's Not CRE, your daily pulse on commercial real estate in America. Today we're talking interest rates, a topic that's on every single investor's mind. Specifically, what the 10-year Treasury is doing and what it means for CRE financing as we head deeper into 2026. It's a story of a new normal, so let's get into it. What's hot? First, stability is here. The 10-year Treasury, which caused so much chaos, peaked at 4.79% back in January 2025. Most forecasters now see it settling into a much more predictable range, somewhere between 4.2 and 4.5% through 2026. That's not low, let's be clear, but it's predictable. And in this environment, predictability is what dealmakers desperately need to get business done. Second on the hot list? The Fed is finally easing, even if it's slow. The market is expecting 2 to 3 cuts in 2025, and then another 2 to 3 in 2026. This means the Fed funds rate should glide down to around 3 to 3.5% over the next year. It's a soft landing, not an aggressive emergency pivot. It signals confidence, and the market likes that. Third, spreads are tight. Credit markets are historically tight right now, which is fantastic news for certain borrowers. If you're well capitalized and holding quality assets, lenders want your business. And that means spreads are compressing. This is a huge advantage if you're looking to refinance a stabilized property. And finally, number 4 on What's Hot: Underwriting Clarity. With rates stabilizing, sponsors and lenders can finally underwrite with more confidence. The new playbook is straightforward. Assume a base case with a 10-year around 4.25 to 4.5%. Then stress test your model at 5%. That's the new rule book. Okay, so that's the good news. Now for the other side of the coin. What's not hot? First and foremost, there is no return to ultra-low rates. Forget the 2010s. The era of sub-3% long-term yields is over. This isn't a temporary blip. It's a structural shift driven by large fiscal deficits, heavy Treasury supply, and inflation that's proven stubbornly sticky. This leads directly to our second point. Higher financing costs are permanent. All-in coupons for core stabilized assets are now running 5.5 to 6.5%. For transitional and value-add deals, you're looking at 6.5 to 8%, maybe even higher. That's 150 to 250 basis points above pre-pandemic levels, and it fundamentally changes the math on returns. Third on the not hot list, cap rates won't compress. It's simple math. With the 10-year yield holding firm in the mid-4s, there's simply no room for cap rates to go down. The bias is flat to slightly higher. Your exit assumptions must reflect that new reality, period. And finally, refinancing risk remains elevated. This is especially true for assets purchased at tight 3 to 4% cap rates with floating rate debt originated back in 2020 to 2022. Those deals still face a serious reckoning. Lenders are demanding lower LTVs, more amortization, and much tighter covenants. The rescue capital isn't coming for everyone. So that's your interest rate update. The bottom line, rates are stabilizing, which is good. But the higher for longer regime is definitely here to stay. Clarity is here, but the cost of capital is fundamentally higher. Underwrite accordingly. Thanks for tuning in. See you tomorrow. Don't forget to like, share, and subscribe. Visit hotnotcre.com to learn more and subscribe to our newsletter.